our recommendation note in September 2020, Shivalik Rasayan has surged more than 2x. While current valuations are well ahead of agrochemical sector and rivals some of the best-in-class players in the industry, its ongoing transformation into a diversified chemical company is a must-watch. We recently had an interaction with the management on the key deliverables to watch out for. The company is one of the leading producers of agrochem technicals dimethoate and malathion, backed by 1450-ton capacity Dehradun plant. Since the current plant is optimally utilized and the company also intends to foray into new agrochemicals and chemical molecules, it is establishing another facility at the Hage. Now, from this unit, the company would also manufacture intermediates, KSM, for captive and third-party consumption. Now, Shivalik has already received environmental clearance to produce 12,000 tons agrochem technicals and 8,000-ton chemical intermediates. To start with, the company will be investing 125 crores for 3,500-ton capacity manufacturing block for insecticides and fungicides in the first phase. Now, this is expected to get operational by Jan 2023. The company would continue to focus on domestic demand. It has already applied for 20 product registrations and has also kept a provision of 1,000 to 2,000 ton capacity at the Hage for its existing products. In terms of exports, the company would be applying for relevant product registrations in the US as well as Brazil. Shivalik's Dahej 2 unit for APIs is operational, wherein for 7 products, the company has reached tech transfer stage from R&D to manufacturing. Here, the company has filed its first DMF to the US FDA for bone marrow cancer API. A superior API in this category is also under development. Shivalik has also submitted 2 CEPs at EDQM for blood cancer and brain oncology. Among key non-oncology APIs, dimethyl fumarate is already developed by the R&D team, and the company is waiting for a stability or a data report which is needed to file the DMF. In case of APIs, the company is targeting molecules which are recently off-patented. For instance, it has the capability to manufacture palbociclib, which is a breast cancer drug under Pfizer's patent, wherein it is waiting for patent expiry in Jan 23. Shivalik plans to manufacture more than 50 APIs at this plant over the course of time, predominantly in the field of oncology. Domestic commercial sale of APIs is expected to start from Q4 FY21. Sales to regulated market are targeted to start from early calendar year 2023, as US FDA audit or product approvals are expected by mid-2022. At the Hage plant, the company plans to construct 8 manufacturing blocks with a total capacity of 1,500 tons. Currently, 2 blocks have been built having a capacity of nearly 400 tons. Of this, 1 is for oncology products. Few of the blocks can be dedicated for contract manufacturing opportunities in the near future. Additional capex per block would be of about 45 crores, wherein lead time of 6 to 8 months is required. Currently, there's a dependence on China, but upcoming blocks of API units are mapped for intermediate manufacturing. About 90% of KSM is targeted to be made in-house to contain supply chain risk. Shivalik's subsidiary Medicam and Biotech's oncology formulation facility in Haridwar is undergoing client validation. Here, the company targets to do domestic launch from Jan 22 in sync with API supply from Shivalik. Now, this is going to be a key near-term trigger to watch out for. It is estimated that in a steady state, 25 to 30% of Shivalik's API sales would be coming in from Medicam and Biotech. It expects the formulation facility approvals from the US FDA and EMEA by 2023 and therefore targets oncology formulation launches in the US and Europe in 2024. Shivalik is undergoing a massive transformation from an agrochem company to a diversified chemicals player. In this journey, some of the key risks have been well anchored. ECs, which is environmental clearances, are available for all 3 capex projects of the group, whether it's agrochemicals, APIs or formulations. Tech transfer, R&D is done for most products targeted for the initial phase of each domain. Balance sheet has been kept clean. Leaving aside working capital requirements, further expansion is expected to be funded entirely by internal accruals. In terms of business strategy, management appears conservative. For instance, it is avoiding more lucrative Para 4 opportunities which can be prone to litigation. Having said that, the domain of pharmaceuticals and chemicals inherently carry an array of risks, whether it's regulatory, environmental, raw material supply, so on and so forth. And that is something investors should be aware of while investing in a company that's looking to foray into newer domains, as some teething issues could well crop up. The other issue is valuation. Is it a good level? Well, if we just look at FY23 estimates, the street seems to be assigning a high valuation. But here one needs to understand that the earnings from recent investments have some gestation period, which will have material contribution only from FY21 onward. Net block has multiplied nearly 5x and 4x for Shivalik and Medicament Biotech respectively compared to FY19, and this additional asset is still to be sweated. This gives an indication of how much earnings can improve from here on, even if the company executes at existing margin levels. Overall, while acknowledging calibrated traction in oncology opportunities, investors need to have a private equity-like approach while investing at the current levels. Investment time horizon needs to be at least 4 to 5 years for business transformation to fructify meaningfully.